Have you ever stared at a flashing news headline, maybe about a stock soaring or a sudden market crash, and felt that immediate jolt? Excitement or maybe dread. Perhaps you've even found yourself searching for that elusive secret formula, the sure thing to pick winning investments. What if I told you that sometimes the biggest obstacle to smart investing isn't really the market itself, but something much closer to home, like our own brains?
That's precisely the fascinating journey we're starting today. Our instincts, which are, incredibly powerful for daily life, can actually be systematically misleading when it comes to financial markets. It's kind of weird. So in this deep dive into your sources, we're going to unpack how our cognitive biases mess with investment decisions, look at the market's weird beauty contest side, and then see how analytical tools like the capital asset pricing model try to bring a more, let's say, scientific lens to risk and return. By the end, hopefully you'll have a fresh, critical perspective on navigating your financial choices.
Okay, let's really dig into this. When we talk about investing, risk is a word that just gets thrown around all the time. But what does it really mean to understand risk? It seems our minds have these built-in blind spots, these mental shortcuts that can lead us way off track without us even noticing. So, where do we even start tripping up?
A fantastic place to start, honestly, is with how we misinterpret statistics, especially conditional probabilities. This is a really common trap. People often focus on the probability of risk-taking given success.
Yeah.
So what percentage of successful people took risks, instead of the much more relevant question, probability of success given risk-taking, which is, if I take a risk, what are my chances of succeeding?
Oh, wow. That distinction already feels huge. Can you give us a concrete example? Because I'm immediately picturing all those rags to riches stories. They always feature these big, bold, risky moves.
Absolutely. Let's use an example from the material just to illustrate. Imagine a sample of 100 people, okay? 80 chose to take significant risks in whatever they were doing, and 20 played it safer. Now, let's say out of these 100, 44 ended up successful and 56 did not. What often gets reported, and what really fuels those headlines you mentioned, is that 32 out of the 44 successful people took risks. That's like 72.7%. And this statistic makes it sound like taking risks is almost, necessary for success.
Right. See? All the winners took risks. I should too. It feels so obvious when you put it like that.
But here's where the deeper truth lies, and it often gets totally missed.
Yeah.
What was the actual probability of success, given that you took a risk? In this scenario, 32 successful people out of the 80 who took risks. Well, that means there was only a 40% chance of success for those who were bold. Now, compare that to the probability of success given no risk-taking. You had 12 successful people out of the 20 who played it safe. That works out to a 60% chance of success.
Wait a minute. Hold on. So in that specific example, playing it safe actually led to a higher probability of success. That completely flips the whole risk equals reward thing on its head. I'm already rethinking every financial success story I've ever read. Seriously.
It's pretty powerful when you see it laid out, isn't it?
Yeah.
The key insight here is, don't just swallow the headline or the anecdote whole. Always question the underlying probabilities. Does successful people took risks really truly mean taking risks leads to success? Well, not always. This totally reframes how you should look at investment stories, venture capital pitches, all of it. And beyond misleading stats, our brains also fall prey to various other cognitive biases. A big one is self-assessment bias. Most people, maybe you too, confidently believe they don't make these systematic mistakes, which, ironically, is a classic cognitive error in itself.
So even really smart, confident people are prone to thinking they're immune. That's a bit humbling. If we're all likely to think we're the exception, how do we even begin to guard against it? Is it like checklists or...
That's a really crucial question. The takeaway from all these biases is pretty clear. Your brain is wired for survival, for quick decisions, not necessarily for optimal long-term investing. So your first line of defense against these errors has to be building a methodical, non-emotional process. It's about consciously overriding those fast-thinking impulses, maybe setting clear decision rules, or doing a pre-mortem, imagining why a decision might fail before you make it, or actively seeking out different opinions.
Fascinating. So it's not just knowing the biases exist, but actively building systems like mental guardrails to counteract them. What other mental shortcuts are we prone to?
Oh, another really interesting one is framing bias. This shows how the way a decision is presented can completely flip our preferences, even if the choices underneath are mathematically identical. There's a classic public health experiment. Participants in a university class were told 600 people were expected to die from some new disease. Okay, so Group A got two options framed as saving lives. Program L saves 200 people for sure. Program M offers a 13 chance all 600 are saved, but a 23 chance no one is saved. A big majority, like 75%, chose the sure thing. Program L saved the 200.
That makes perfect sense. Yeah, when lives are on the line, people want certainty, right? Save who you can. Seems logical.
You'd think so. But then Group 1 got the exact same mathematical options, just framed differently in terms of dying.
Hmm.
So Program X meant 400 people would die for sure. Program Z meant a 13 chance none would die, but a 23 chance all 600 would die. And here, 75% chose the risky option, Program Z.
That's incredible. But like, wait, Program L is the same outcome as Program X, just worded differently. And M is the same as Z, yet people's choice is completely flipped just based on whether you said saving lives or dying. It's like our brains react to the packaging, not just the actual contents.
Yeah.
How often do you think this framing stuff plays out in like financial news or how investment products are sold to us?
Oh, constantly. All the time. This bias is heavily used in financial marketing. The way a return is presented, the language used to describe risk, maybe framing something as a limited time offer. It can subtly nudge us into decisions we might not make if we just looked at the raw numbers. The takeaway is critical. Always look past the pitch, the glossy brochure, the excited headline. Strip away the frame and focus on the cold, hard numbers and the actual probabilities.
Wow, that's really powerful. And then there's that thing about us seeing patterns where maybe there aren't any, right? It feels like we're always trying to find a story, even in randomness.
We absolutely are. Our brains are pattern recognition machines. It's evolutionary. Think about the saber-toothed tiger analogy. If the grass rustles, maybe it's a tiger, maybe it's just wind, the cost of not running when a tiger is there is way, way higher than the cost of running when there's no tiger. So we're biased towards seeing patterns, assuming cause and effect. Or think about Skinner's chickens. They'd peck a red circle, and then randomly food would appear. They quickly started thinking pecking caused the food, a false pattern.
Oh man, I've definitely caught myself doing that with stocks. You see a stock tick up a few days in a row and think, aha, a trend, when it could just be, well, Skinner's chickens playing the market. It's so hard not to see a story there.
It absolutely is. And this brings us nicely to the idea of fast thinking versus slow thinking. Fast thinking is emotional, intuitive reactions. Slow thinking is deliberate, methodical. Investing, with all its uncertainty in these deceptive patterns, absolutely demands slow thinking. It requires taking time to analyze, reflect, and consciously push back against those quick emotional urges, even when your gut is screaming, act now.
Okay, here's where it gets really interesting for me. If our individual brains are wired like this, easily misled by stats, swayed by framing, seeing patterns everywhere, what happens when millions of us, all with these same biases, get together in the financial markets? Does it all just cancel out, or does it create something messier?
Oh, it creates something far more complex and, yeah, often irrational.
Mm-hmm.
This is where John Maynard Keynes' famous beauty contest analogy for the stock market is just so spot on.
Mm-hmm.
He described this hypothetical newspaper contest. Readers don't vote for the woman they personally think is most beautiful. No. They vote for the woman they think most other readers will vote for as most beautiful.
Mm-hmm.
The prize goes to whoever matches the crowd's pick.
Ah, okay. So it's not about intrinsic value, like actual beauty in this case, but about predicting what everyone else thinks. It's a game of guessing what other people are guessing.
Exactly right. And in the market parallel, investors aren't necessarily buying the quote-unquote best company based on its fundamentals, its profits, its real prospects. Instead, they're often buying the company they think other people will want to buy soon. This dynamic can lead to the market kind of chasing its own tail. It creates this alternative reality where prices can get totally detached from the underlying value. And that contributes big time to instability, volatility, even speculative bubbles.
That sounds like a recipe for a really uncertain and, frankly, pretty stressful market. It almost feels less like investing in actual businesses and more like playing the super complex guessing game where the rules keep changing based on everyone else's second guessing. How does an investor even avoid getting sucked into just being another player in this beauty contest?
It's a huge challenge, and it means consciously deciding to focus on the underlying fundamentals, the long-term value, rather than trying to surf the waves of short-term market sentiment. It definitely brings in elements of game theory, too. Remember the marriage game example. Dave and Diane want to go out together, but maybe he likes opera, she likes sports, and they forgot to coordinate. Without coordinating, there are multiple possible outcomes, right? Maybe they both go to the opera, maybe both to sports. Maybe they end up going separately. It's uncertain. That kind of uncertainty where what one person does depends heavily on what they think the other will do mirrors the market perfectly. Because in markets, that clear coordination just isn't there. It leads to uncertainty, maybe suboptimal results for everyone. The point is, markets lack perfect, rational coordination. You got to be wary of assuming everyone else is acting purely on fundamentals. Often they're playing that beauty contest.
So, what does this all mean for us trying to invest? If markets are partly this giant, slightly crazy beauty contest driven by our own quirks and biases, how on earth do we make rational, informed decisions? Is there some kind of scientific framework, like a compass maybe, that can cut through all this noise and give us something solid to hang on to?
That's exactly where quantitative finance tries to step in, to bring a scientific lens to the chaos. A really foundational model here is the capital asset pricing model, or CAPM. It's designed to quantify risk and figure out the expected return you should get for bearing that risk. The core idea, the really central bit of CAPM, is that there's basically one main source of risk you get paid for taking. The systematic risk that the whole market will go up or down. Everything else, like risk specific to one company. That's called idiosyncratic risk, and theory says you can diversify it away.
Okay, so it boils things down to how much a stock or whatever moves when the whole market moves. That's a really powerful simplification, if it works.
It is. And the measure of that sensitivity, how much it moves with the market, is called beta. So if a stock has a beta greater than 1, think of an airline stock maybe. It's an amplifier. When the market goes up, airline profits, which are super tied to the economy, tend to amplify that return. They go up more than the market. If a stock has a beta less than 1, like, say, a grocery store stock, it's more of a damper. Sales are pretty stable, right? People need groceries regardless of the economy, so its returns are less sensitive to market swings. They move less than the market. The key idea here is CAPM gives us a way to actually quantify market risk, offering a more analytical handle on potential returns, instead of just relying on gut feelings.
Okay, so airlines are high beta, grocery stores low beta. That makes intuitive sense. But what about something really, really different, like a negative beta? Can that even happen? A stock that moves opposite to the market.
It's pretty rare, but yeah. The sources actually give this fascinating personal example. A law firm, Catherine Co., that represented plaintiffs in security fraud cases. Think about it. Their profits actually went up when the market went down, because that's when people tend to sue brokers and companies. So when the market was booming and everyone was happy, their firm made less money. When the market tanked, their business picked up. That inverse relationship gives it a negative beta. And that makes it incredibly valuable as a diversifier in a portfolio because it zigs when the market zags, acting like a hedge.
Wow. Darling, you have the most beautiful negative beta. I can just picture that conversation. That's such a brilliant, like totally counterintuitive idea. It flips the script on what a good investment even looks like, depending on its role, right?
Absolutely. Yeah. Now, CPM predicts that all correctly priced stocks should fall neatly on a straight line. It's called the security market line, or SML. On this line, the expected return goes up directly with beta. Higher beta, higher expected return. It's fundamental for figuring out if a stock seems fairly valued for its risk. Now, if a security falls above or below this predicted line, it's said to have a non-zero alpha. Alpha is basically seen as a measure of mispricing relative to what CAPM predicts. It suggests there might be a trade opportunity, a chance to get a return that isn't just payment for taking on market risk. Finding this alpha, that's the holy grail for active fund managers.
Okay, that sounds incredibly logical, very scientific. This model seems to offer a clear map: find things with positive alpha, avoid negative alpha. But does CAPM actually hold up in the messy real world, with all those human biases we just spent time talking about? Or is it just a beautiful theory trying to fit into a very imperfect human-driven market reality?
That is the critical question. And it's where the big debates in finance really happen. Because when you test CAPM against actual market data, well, its predictions often fall short. Empirically, the results aren't great. Studies often find the line's starting point, the intercept, is too high, higher than the risk-free rate should be. The slope is often too flat, meaning you don't get as much extra return for extra beta as the theory says you should. And frankly, the model's overall explanatory power, its R-squared, is often described as terrible. It just doesn't explain that much the difference in average returns between stocks.
Huh. So if this elegant model doesn't perfectly match reality, what does that mean? Are these differences, these deviations, just mistakes the market is making that smart investors can jump on? Or are they hiding something else entirely?
This leads directly to a fundamental, ongoing debate. Are these deviations from CAPM often called anomalies? Are they actual mispricings that active investors can exploit for profit? Or do they represent compensation for risks that CPM, in its simplicity, just doesn't capture? Take, for example, high book-to-market firms. These are often called value stocks, low market price relative to their accounting value. maybe few growth prospects. Some argue these are mispriced, undervalued, an opportunity. Others say no, they just carry higher bankruptcy risk or distress risk, something CPM ignores, and investors demand a higher return for that specific risk.
So it's this constant question, is it a free lunch opportunity or just a different kind of risk the model isn't seeing?
Exactly. Another big anomaly is momentum. Past winning stocks tend to keep winning for a while. Past losers tend to keep losing. This is really puzzling for efficient market theory. Why would such easy-to-spot trends persist? Shouldn't they be traded away instantly? Then there's idiosyncratic volatility. That's the risk specific to just one stock, not related to the market. Counterintuitively, sometimes stocks with really high idiosyncratic volatility actually have lower average returns. Why would people accept lower returns for more unique risk? Mispricing, or something else. And finally, maybe skewness or lottery-like payoffs. Think penny stocks or stocks that had a huge jump recently. Small chance of a massive payoff. These tend to have lower than expected average returns. Maybe people overpay for that tiny chance of hitting the jackpot, that lottery ticket dream, causing mispricing. Or maybe it reflects a specific preference for long-shot possibilities. This whole debate, mispricing versus hidden risk, is truly central to deciding your investment strategy. Are you going to hunt for these potential alphas, believing you can spot mispricings?
Or are you better off acknowledging these complexities and maybe sticking to a more diversified passive approach? So if you take one really profound thing from this whole deep dive, it's probably this. Effective investing isn't about blindly trusting your gut feelings, but it's also not about rigidly following any single inevitably imperfect model. It really demands critical thinking. It demands a deep awareness of our own cognitive biases, those mental traps we talked about, and it requires a methodical, non-emotional approach to weighing up risk and potential return. The market, as we've seen, isn't very sympathetic to human mistakes.
I love that. It really is a blend, isn't it? Understanding our own human nature and applying rigorous analysis. It pushes us to move past that default fast-thinking mode and embrace something more deliberate, more purposeful in our financial lives. It's almost like being smarter about ourselves first is the key to being smarter about the market. So as you continue navigating your own investment journey, maybe always remember this powerful idea from the sources. Part of knowing is knowing when you know and knowing when you don't know. When you think you've spotted that amazing opportunity, that mispriced gem, have you genuinely accounted for everything the market might already know? And for all the biases your own brain might be throwing into the mix? Or, when in doubt, is that well-diversified, maybe passive strategy the more prudent path? Accepting that maybe you don't know enough to consistently beat the beauty contest.
Exactly. Really reflect on that quote. It's a cornerstone of disciplined investing, I think. And hey, let us know what resonated with you most in the comments below. Did any of these biases ring a bell? Or have you felt that beauty contest pressure in your own investing? Keep learning, keep asking questions, and keep thinking critically about what truly makes an investment decision sound.